Well, good afternoon, investors. Welcome back to the April 25th edition of Bull Sessions. I expect that you either filed for extensions or you completed your taxes on time. And it is time to start warming up for Cinco de Mayo, Ken. I don't know if you're going to be out of town for that, but we do need to start making some preparations, including some more of those adult beverages that are on display on the screen.
Just a really big bottle of prepared margaritas is all you need, Mark.
And it doesn't take long. Well, as we were observing just a few minutes ago, the cover slide has made quite an evolution during the 3 weeks of this session, and the chips are flowing in my direction, so the dogs and the birds are coming to me. And Annie has decided to remain at the slot with all the aces, including the ace getting passed to her by Winston. So it's sheer bedlam when it comes to this stuff. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and we are the sponsor of this show. And I'm joined by my wonderful dear colleagues, Ken Kavula and Matt Spielman. Good afternoon, gentlemen.
Good afternoon, Mark. Good afternoon, Matt. It's great to be with you guys.
Good afternoon, guys. I was going to say, Mark, I think that part with Winston just goes to reinforce that you can improve your odds for the group. That's your past ace.
Well, Tillinghast actually has a quote that he thinks that the amount of nefarious and low ethics behavior happens during bubbles. So maybe we're witnessing a bubble there. Good stuff. And Matt, thank you. I did change the plane to a helicopter for the turkey up in the upper left.
I'm a stickler for historical accuracy.
All right, let's go ahead and get underway. Standard disclaimer, no investment recommendation is intended. We'll talk a little bit less about companies today, but there will be some mentioned. Please take everything that you see as an educational demonstration. Everything that we do here is to just demonstrate and illustrate the methods, techniques, philosophies of the modern investment club movement as promulgated by either Manifest Investing or the National Association of Investors, also known as Better Investing. So you'll hear opinions from us. Please do your own homework, and any decisions you make, they are yours to make. If we own something, we'll try to remember to disclose that and let you know. We do have a roundtable tonight, so we probably will truncate this a little bit, but who knows. The roundtable is our monthly webcast where 3 or 4 or 5 of us come together and make a selection and walk through the analysis of a particular investment opportunity. If you'd like to be added to those, they are webcasts. It is generally the final Tuesday of every month at 8:30 Eastern Time. Tonight we are starting at 7:30 for a special educational session, and then we'll go into the traditional roundtable at 8:30. Those are Eastern times, but again, it's a monthly webcast. If you want to be added to the reminder list, send an email to nkavula1@comcast.net. Then if you have any other further follow-up, our 2 email addresses are down at the bottom of the page. Anything else, Ken?
Yeah, Mark, Natalie has asked me to ask our folks out there in our different audiences that if you do come up with a new email address, if you've changed your email address, instead of trying to reach her by phone, it's easier if you just drop her a note at the new email address, and somewhere in that note, if you could reference the old email address, she would be appreciative of that.
Okay. Thanks. All right, we'll get a couple of the traditional departments out of the way before we launch into part 3 with Matt, and primarily focusing on Tillinghast this week. Here's our look at the stock market as measured by the companies in the Value Line Standard Edition. That's basically the price bars represented by the green bars. And again, that line of reasonable expectations is simply computer-driven regression through those historical data points. And we tend to believe that the green bars will ultimately get there, and that we believe that periods like this are kind of anomalies where stocks were overpriced a bit. I think this is the best explanation I've ever seen for that bubbly time frame. Sometimes things just get a little bit ahead of themselves. But the fact that the green bars are below the blue line means that there's generally a few more stocks on sale than have been in the past couple of years. And the average forecast is now at about 12.5%.
Yeah, there's nothing magic about that average, but if you'll notice in the yellow box, the long-term average is 11.6. So we're basically close to a pretty average market right now, no matter what the talking heads on television might be trying to convince you of this month or this day or this hour or however long the time period is.
And this week's quote from Tillinghast is, I think it's just a great paraphrase of the buy and hold, comma, for as long as it makes sense to do so. And that's basically our rule number one. So good quote from Joel. Anything else, Ken?
No, but I think that I'll put that quote in a couple of the things I send out to my clubs. I've been putting the buy for as long as it makes sense to do so in a lot of my writings, and we'll add this as well as back up to that as reinforcement.
Yeah, and we'll cover Tillinghast's recent performance here in a few minutes. Just a couple things from Twitter. I think the one on the left is definitely from Twitter. And this is just a quick update. We had talked a couple of months ago about how many flavors there are of CPI and some of the gymnastics that are done around the number. And this is from an individual that likes to make adjustments to the adjustments for housing and shelter that are reflected in the average. And the bottom line, or the nutshell explanation, is there's a number of fairly smart people that have been pointing out that the situation with rents and mortgages has actually been worse than is displayed in the conventional CPI. And it's just simply confirming what they already believe. And on the flip side of that, the recovery or the slowing down is happening faster than many people believe. So I know you follow this stuff fairly closely, Ken. What are your thoughts?
I've been saying this for a year now, Mark, that I've thought that there were just too many discrepancies between what actually happens in a real household with shelter and what the CPI is reflecting. And I've always thought that they're taking bad numbers from both sides of the spectrum, numbers that are way too high and numbers that are a lot of times way too low, and then they're averaging them together and giving you a value that doesn't have any real meaning to it. The CPI is a lot different for a retired person as far as shelter is concerned. For a retired person who doesn't have a mortgage and is living in the same house they've lived in for 20 years. Versus somebody that is out searching for a mortgage and buying a new home with virtually nothing down. So they're really different circumstances, and I'm not sure that the calculations that are being done reflect the huge discrepancy in situation, and then on top of that, the huge discrepancy in geographical location. I mean, come on, these numbers have to be a lot different for the New York City metropolitan area than they do for the Omaha, Nebraska area, or the Laurel, Mississippi, or the, name any of 1,000 small towns throughout the Midwest.
Well, I'll tell you, my dad's been gone a couple of years now, but one of the things he used to fairly reliably do would be to point out the CPI numbers, which drove the retirement plan payments to him. And he would sit down and he would say, well, here's the stuff I actually eat, and here's my electric bill, et cetera, et cetera. And he would compare the year-over-year numbers, and they never matched even close to the CPI numbers. And he just continually shook his head. And I don't know if he did that to torment me or entertain me, but it was pretty reliable.
Probably a little of both, Mark. Okay.
All right, the graph on the right is just a little bit of a follow-up. I had told you that some of the forecasts are getting a little bit weird. what you're basically looking at here is the universe of companies is the value line standard edition along with their return forecasts. And I had talked about how they were actually getting more dispersed, but what we're actually seeing, it's unlike what I've seen in a while. This is usually narrower and steeper, more like a bell curve. And this is basically been flattened. And on both ends, either the very low forecasts, in some cases negative here, or off the charts into too good to be true land, these are much higher. So what we're left with is a kind of a, well, Matt said it in the pre-session, if we just put a little face on this up here, this looks pretty much like a shrugging emoji, right? And I think that's exactly, it captures the spirit. It's very distributed. This is the sweet spot is out here. There's actually fewer companies here in the sweet spot than is typical, because that's usually includes these. So anyhow, it's just things are a little bit weird. The other reason to bring it up is with the end of 2022 numbers getting locked in and the first quarter numbers that are just now rolling in, I believe that a lot of these are going to go this way and a lot of these are going to go this way. In other words, the analysts are going to be correcting forecasts in a big way. It's happening every day as the numbers tick in.
Mark, tell me which piece of data this is actually graphing from the value line sheet.
It's actually from manifest. It's the projected annual return. So these are manifest returns.
Okay.
But the companies are the value line standard edition.
Okay.
And Matt asked the question earlier, how many banks are in this yellow one over here? There's quite a few banks. And a lot of those are pretty confused right now. A lot of shrugging going on in the regional bank industry. All right. Quick look at our groundhog. No change in leadership. Orange County Model Club continues to lead the group entry. Kim Butcher has a narrow lead on Matt for the individual session. David Einhorn and Warren Buffett continue to duke it out in the celebrity end of things. I'm just happy to be on the list at number 14, and I've been asked to advise you that Ken is somewhere around number 47 and Herb Lemkool is around number 43. So all things are right with the world, including the fact that, yes, Ken, the monkey's approaching the bottom of the list this year.
All right. So my theory about being very average works out then. Okay.
Well, yeah, I mean, he probably is going to follow that value line, and the value line arithmetic average is lower than I've ever seen it.
Yeah.
71st. All right. Here's our best small companies. Just a quick update. Portillo's continues to hover in the middle of the list, looking for a lot of hungry people out there. Today is a big day. A lot of earnings going on either yesterday, today, or tomorrow with some of the companies that are in that very influential group of stocks listed in the bullet point up at the upper right. So it'll be interesting to see how the red bar holds up against the green bar. Judging by what's going on in the background, I don't think I think the red bar is falling as faster than the green bar today. How's that for an in-depth, highly technical, spot-on description, Ken?
I think it's enough for us to move on, Mark.
Yeah, no company updates, although we did have MP Materials has been showing up on a number of screening results. So with that, Matt, let's go ahead and finish off the dual book discussion. Again, for those of you that are not familiar, we are basically talking about two books. The first, Thinking in Bets by Annie Duke, the poker player and hedge fund consultant these days. And she actually runs an organization on decision making, decision research, which is kind of interesting. We may come back to that at some point. But so Annie wrote that book, and that's been the basis of much of the discussion, and as well as Joel Tillinghast's Big Money Thinks Small book. And Joel is the manager of long time manager, founding manager of the Fidelity Low Price Stock Fund. And we'll actually look at current performance here in a few minutes, but you can see over the years, that's a pretty good differential between the benchmark and the results achieved by this guy. Again, investing, we believe, fairly similar to what we do, the type of stocks that we pursue. Any comments, Matt?
I got the only other one, I think we closed last week on it, looking at the left, it's Joel Tillinghast and Company, right? The idea that Annie's main point is the best way that you can overcome your biases and blind spots is to work with someone else, with other people that you I'll say you admire or you think have compatible ways of thinking of things very seriously. Joel's no different. He was solo for a very long time. And then has brought on people. It'll be interesting to see how the fund performs after he's gone and see if that's a lasting legacy too.
Yeah, and you can see just on the right-hand side of the chart that basically from this point on out to here, pretty decent performance by the group, as these people fluctuated into the fund. So not bad relative performance, even by the team. All right, and just as a reminder, we find that the approaches are fairly similar, and it's one of the reasons that we like to study Tillinghast's legacy and work in greater detail. My favorite, I said it last week, I'll say it again, the fact that Walter Schloss was mentioned and that value line is used as the source of ideas and part of the foundational research for companies. I find fascinating, much like Walter Schloss.
Yeah, and that Joel's quote on the right is current state in 2018, right? It wasn't I used to and now I've migrated to whatever screen tool or whatever. That was current tense.
Yep, print copies. Although he probably uses a blend, but he's relying on those pages. All right. Just some reinforcement that part of the discussion with Annie led us to the similarities between what she does and investment clubs. She refers to them as decision pods. And I can think of several times during my years in investing where my decision pod kept me out of trouble, much like the WKRP situation shown here. Interestingly enough, Matt, I don't know if Annie's old enough to really, she must have watched this on reruns because she's not old enough to know about falling turkeys in Cincinnati.
I told you I actually have that recorded, and I don't know that I hit double digits when I did that, but I actually have this episode recorded on a VCR tape.
No kidding.
Yeah.
There is this thing called the internet and YouTube, Matt, that can handle.
Well, no, it's preserved for what it is. It's just to say I know that I have it. Yeah, you all have seen it. That's great. I have it.
All right. So
should I be offended? You didn't even ask me if I was old enough, Mark?
Well, some things are just assumptions and stipulated.
You had answered the question before. You knew where WKRP was, so
he did.
He knew you were a fan already.
You actually went to college within walking distance of this place, right?
No, Mark. Ohio is a big state, and I was about 400 miles away from Cincinnati at this point.
Okay, so it's a healthy walk.
Yes, it's a healthy walk. Okay.
Good stuff. And as Ken was mentioning, we are going to be in Cincinnati on Saturday morning and afternoon, having some fun with the local audience there, and that's always a good time. In fact, we'll have a promotional plug for that tonight at the roundtable. Again, just a reinforcement that Annie ended up, I think one of the more fascinating things about the book, at least for me, was her description of how she became a better poker player by seeking advice and information from her opponents, arch rivals in some cases, and basically forming these little groups that would provide for the opportunity of learning and improving performance. And really kind of a neat thing. And Matt has put together an entire series. I look forward, Matt, as you continue to refine this into an exploration of a model for investment clubs.
Yep, long way to go to get it to digestible bites, but I think having an abundance of material will end up being a good thing. That it'll be pretty easy to tailor it to different audiences.
Okay, so with that, we're going to go ahead and pick up where we left off with Tillinghast and Big Money Thinks Small. What we've got here is basically a set of quotes which we can expand upon and expound upon that Matt has put together. But as we said, we enjoyed much of the book. A little bit at the end left me scratching my head a little bit. Might expand on that in a minute, but want to cover the topics as Matt has grouped them. So go ahead, Matt. What's your favorite here? What?
Well, I guess maybe one place to start, kind of in summary too, and Ken, you had a great point in the green room. You know, Joel doesn't go out and say, you know, these are the 3 main points I want to bring up, and we all have our most important points that we see in the book. I do think it's very central to Joel's view, and again, we've talked about it before, the idea that investing is perpetual. That anytime you put a time frame on something, that brings in a degree of speculation, and that's where we had the discussion last week about is investing gambling, and of course it depends on what type of investing you're doing. But I think that if you believe investing is perpetual, that in its purest form or best form it's forever, that helps you have an even temperament when storms come by. That helps you not be overly enthusiastic when bubbles come up. That, you know, I think that kind of gives him his zen about what investing is and being consistent in his approach. Maybe looking specifically at this one in research, I really liked the last bullet here. The idea that we need to understand why things happen more than what happened, and that gets into, and there was an excellent start of a discussion in the forums around Bed Bath & Beyond, and I think it was you, George, who asked if we were resulting, right? That's the term Annie uses when we simply judge an outcome or judge a decision by its outcome without taking into consideration what element of luck was there and what was skill, right? You could have a very strong hand and play that hand and still end up upside down if certain unlikely things happen. So I think that I don't think we're quite I don't think the details are quite clear enough yet that we could do a case study on Bed Bath & Beyond. But if anyone is taking away from our conversations something to do, pondering about where that went, and I don't think any of us would have been a Bed Bath & Beyond investor, at least in the last year or two. But if you had, or if you had considered speculating in it even, what were the factors that really came out of this or would have made your decision?
Yeah, I saw the comment in the forum, Matt, and I think I agree with George Mackey. Annie spends a lot of time in the book talking about the Super Bowl moment with Pete Carroll and throwing the interception at the goal line versus the New England Patriots when they had the best running back in the league, and basically Pete Carroll caught nothing but grief the next day, and she just basically points out that actually it was a fairly strategically correct call. The outcome was extremely unlikely. That didn't make it a bad decision all by itself, but the fact that it lost the game for them, I mean, Pete Carroll caught nothing but grief. And just think about what would have happened if the pass had been caught for a miraculous touchdown to win the Super Bowl. And extending it to the Bed Bath & Beyond situation, as I read some of the stuff that's being, some blame and fault being placed upon the leadership of the company right now, I think George makes a pretty good case that there are some similarities and parallels there. Again, the outcome driving criticism of a variety of different decisions that were made along the way.
Mark, are we reading Annie Duke or are we reading Tillinghast on this page?
These are all Tillinghast quotes.
These are all Tillinghast, yeah. Which is interesting that there is such a crossover. We've made that point a couple times, that there are a number of very tight crossovers between the two books.
Yeah, I just went to page 33 in my copy, and it's almost completely underlined. And I see Matt had the same problem with picking a quote that he he really wanted to quote, because a lot of these are from page 33 here.
Hmm.
The thing that strikes me more than anything else is something that I've believed in for a long time in better investing, and that I've had a very difficult time convincing anybody else that it's true, and that's that quarterly numbers don't mean a whole heck of a lot. And I think that he's saying that in at least 3 of the 6 points that are on this page, that he talks about quarterly numbers being important in the, when you look at them in the aggregate of years rather than a single number. He talks about looking at them as if they are not going to mean life or death for the company, and not making a decision based on a single quarter. And then he doubles down by saying, tilt the odds in your favor by viewing data over long time horizons. And, I think that the fact that we include quarterly numbers on a stock selection guide gives them more import than they're actually worth. Maybe they should appear as a footnote, or maybe under a different tab. I know that it's nice to stick another dot on the graph when you have a quarterly number, but maybe you don't need that dot. Maybe the trend line through the fiscal years is all you really need to consider what's happening with the company itself. I'll put all those ideas out there and know that I'm going to get blown out of the water by some of the traditionalists in the audience. I don't regard myself as a traditionalist. I never knew the
Well,
original people that put these rules together,
well,
so I'm kind of free to interpret them on my own, right, Mark?
are you intentionally teeing me up or poking me with a stick or what?
I'm not teeing you up or poking you. I'm giving you the ability to talk about certain documents that I know people hold as holy, and that when asked and when questioned, I say to them, I don't even use the darn things. Don't
Yeah.
ask me questions about them.
Well, I can give you the fact blended with a little bit of opinion. The fact, as I understand it, was Mr. Nicholson. Again, he basically invented the stock selection guide. He was, I don't even know what word to put on it. He was not happy about the quarterly stuff being there in the first place, and basically wanted to think more in terms of year over year. And he did regard the quarterly stuff as a distraction, and probably an insignificant enhancement that might have even been a distraction. And I believe that's pretty close to a quote. So, we use it at Manifest, but only to the extent that any quarterly numbers, and including forward-looking quarters, actually deflect the long-term trends or regressions. So that's how they come in, and it takes a lot to make a huge deflection in that. So we do pay attention to quarterly numbers, but we don't emphasize them like Wall Street does. So,
Well, I just get very tired of listening to our own practitioners get all caught up in what has the company done for the last quarter or the last 2 quarters, and then trying to make a decision based on that behavior. I just don't think that's enough time. It's not. Usually there's nothing significant happening that might not be happening in the entire industry or the entire economy, and to look at 2 quarters and to say sell or buy, I think is an exercise that the time is being, dare I say, wasted. There's better things to do as an investor than to examine short lengths of quarterly data, short lists of quarterly data.
yeah.
Now, if you're going to give me 20 years, that's a different story. But
Matt, we're drifting a little bit off trajectory, but I think it's an important point. I mean, I could provide you with a number of case studies. Take Five Below, for example. If you basically started making decisions on Five Below based on what happened in March 2020 and June 2020 and September 2020, you would have ended up making the wrong decision. And that's at the risk of paying more attention to a temporary condition versus the long-term trend. And Cy Lynch lived it. He made the selections for the roundtable. I thought he was crazy, but Cy was right about that particular company, and there's a whole bunch of examples of that.
No, I think this is right in line, Mark. Again, I think Joel's central point about investing being perpetual, being long-term, is right along with these. And I would say, the example in front of everyone's face is the regional banks, right?
Mm-hmm.
So there was a quarterly shock, and part of determining why things happen is there some kind of ongoing impairment to the whole group, or were there a few plain risks that have brought headlines and things will revert to normal? Or again, not meaning that things will be exactly as they were before, up to and including the stock price, but things will go that way. And I think there is a lot of activity in the market that's based on much shorter term things. What the Fed's going to do next week, what inflation's going to be, what commercial real estate's going to be, which might be a little bit kind of the bigger term, but it's still about this year, versus the idea of a role of a community bank versus a money center behemoth bank.
Well, we can move on, but I did want to point out to the audience, I'm not sure how many of you are out there, but Western Alliance Bank went up 1% while I was talking.
All right. There's a great essay out there, Mark, that says, when I'm 75, I will wear purple. And the point of the essay is that you earn the right to give advice without listening to anybody else's advice, and you earn the right to say things that might be shocking coming from a younger person. And since I turned 75 a couple years ago, I'm willing to make the point that when you use language like toxic, that the analysts are using right now about the regional banks, I don't think you do anybody a favor. I don't think you help the investing public. I don't think you help your own reputation. I certainly don't think you help the discussion about what problems the regional banks are facing, if any. And I've been watching these analysts. Maybe it's just envy about their age. They're so nice and beautiful and young, but I just am watching so many of them use what I feel is inappropriate descriptors to talk about what's happening with banks. They see it as a crisis, and I'm afraid that if we don't watch out, mobs can be easily talked into a lot of things, and I don't want to talk a mob into deciding there is a crisis and doing a real run on most of the banks in the country.
So you're in favor of a crap detector?
Okay, yeah, that would be nice. Okay.
Well, that fits with Matt's next slide. So.
Okay, good.
Good roll.
Yeah, and I would say the quote from page 60, the longer quote, fourth one down, is kind of getting back to what you were talking about, Ken, right? So he says, if this piece of information is not going to be applicable in a year or two, maybe it's just clutter. Maybe it really shouldn't be paid attention to. I do think Marty Eckerly has a good question as we're talking about quarterly results and what they mean. How about trailing 12 months TTM history versus the full year history? Particularly maybe into the third quarter when we're almost there.
Well, I don't know how the rest of you feel, but I'd certainly give trailing 12 months a little bit more credence than a single quarter. I'd rather see trailing 36 months data. But I'll buy trailing 12 if that's all we have available.
Yeah, and of course, naturally, a trailing 12 takes out any seasonality that's in. That can be very noisy in numbers also. Talk about the comps, year-over-year comps. That can be kind of crazy. All right. Anything else on this one?
I think we move. I have the strong urge to say some things I know are on future slides, so I think we can move on.
Okay. One thing that I did throw in here for the audience is just an example of some current research, particularly because it includes some guidance right now from Joel Tillinghast on the lower right. And what he's basically telling us is they do see a lot of opportunity, as we have been talking about here for months now, in the small and medium-sized companies. And this is the most recent quarterly report from the folks at Fidelity. You can see that the low-price stock fund has moved up to superior performance again. And I just found it kind of interesting, especially with some of the inflation-related questions that we get. It appears that Tillinghast is pushing towards a few of the more economically sensitive companies. You want to do it carefully, though, but with some experience. But you can see that he and the team are apparently shopping amongst some of those type of companies, perhaps a few companies with lower EPS stability or predictability numbers, but still strong companies with growth.
Yeah, I'm looking at the top 10 holdings in the middle there, the ones you don't recognize. Elevance Health. I'm not sure I even know what Metro Inc. does. It's an interesting broad one.
Yeah, and I think maybe we'll come back and take a look at some of the more active accumulations at a future session by these guys. You know, what are they actually putting money where their mouth is at a future session? All right, Matt, take us away to management, one of our favorite subjects. What are Tillinghast's thoughts on management?
Yeah, well, I believe isn't it a who am I trying to think of? There's a quote: "Make sure you have a business that can be run by idiots, because eventually it will be." I don't think Joel is kind of that way. Actually, that's anyway. But I think that's part of his seeking out consistency, right? So just as he doesn't want us as investors to be going with the flavor of the day or changing our investing style over time. He also doesn't want businesses to do that. He's looking at consistent growers. The page before talked about non-cyclical kinds of. He's talking about non-cyclical impacts. There's positive and negative, right? There are, let's say, the changes to the tax laws, which some of them are coming up to expire in 2025. Kind of getting a feel in the next election cycle about where that might go. But looking for things. In fact, I was just another Motley Fool item went along with number 5, looking at companies that have a bland character, right? So it may be sort of boring, but if they're getting good results, that might be enough. I also, well, now I'm going to say it again. I again have the urge. I think I have it in another slide. One of the things I love, Warren Buffett kind of taking a cue from Ken and saying, I'd rather be vaguely right than precisely wrong, right? Drawing with a crayon. That kind of thing where, if I was right on Western Alliance and I'm up 50% or I'm up 100% or 200%, I don't really care. I'm still buying beers at the end of the day. So things will turn out better than you hope, and things will not turn out as well as you hope. But if you are consistent in looking at it, then you should move the whole portfolio together.
Well, Tillinghast, I'm sorry, finish up, Matt.
No, go ahead.
Tillinghast made the point a couple slides ago that your mind can only hold so many facts. You learn that as a good teacher also, that you can't overwhelm somebody with fact after fact and hope that they're going to maintain any resemblance of understanding about what you're talking about. I really, the same one you picked out, many companies have a bland character. If after, and I'd say 15 minutes, not an hour of study, you're still baffled, don't sweat it. I think don't sweat it is pretty good advice for a lot of folks that find themselves getting caught up in this. I have to know 70 facts about my company before I will even consider buying it. This analysis paralysis that overtakes so many of the people in our community. I think a lot of it has to do with the fact that they're just trying to understand a bunch of numbers that in a lot of cases don't make that much different. And maybe don't sweat it is something we should embroider on one of our pillows and give to our clubs along with up, straight, and parallel, Mark.
Yeah, and I just love the one when a company goes against a a well transcribed history, I generally expect the past to catch up with it. That's so true. All right.
And maybe towards the end, I probably could break this up and talk more about product. Starting with the fifth from the bottom, right? Looking at companies that don't do everything their competitors do, right? Are doing things competitors are not doing or doing badly. And this might be a little bit broader scope than that idea is, but think of all the big tech and the layoffs they had, and their stories, of entire teams at Meta that were kind of bored, that they were held for future growth in the race for talent, and no expense spared in coddling them. And then you look at Apple, who didn't lay anybody off. Was that because Apple's business is still booming? It's different. No, they have challenges. They never took up the fevered hiring on the upside. So just a much more even-handed expectation that today will take care of today and tomorrow will take care of tomorrow. But then the last four, you kind of group them together and look about addressing the market and talking about what edge might a small company have over a big company. Take the first one there, right? Looking at market niches rather than the whole market. And the last one, the third to the bottom, I really like too. It's maybe I should put that in bigger type, right? You can generally talk about competitiveness in superior products, and whether you just say quote unquote quality or have certain features they have, or low prices, right? We can all take certainly products and certainly retailers and sort of put them into rough bins on those ways. But there are a number of sources you go back to and come back to and say that quality, or let's just say superior products, tend to be more lasting than low price or simply competing on price. And then at the very bottom, right? Unless the customers view a product as a commodity, or don't view a product as a commodity, as a commodity, right? It doesn't matter what the management says. It doesn't matter what someone else says. If you see people easily substituting things, think about PC brands. There are brands of PCs. None of them have a lot of intrinsic value when you look at the sort of brand evaluation, because they all run the software we want to run. Think about that in terms of phones, right? So if you took the profits of all, and this is several years old, but if you took all the profits of all the mobile phone providers together, Apple's profit plus Samsung's profit is greater than the whole industry's profit.
Mm-hmm.
Meaning on whole, every other provider loses money because Android is a commodity, and that's how it's positioned. And you can guess who gets the money for the value that comes from that, right? It's the underlying search. So there are a lot of interesting points where people may be growing revenue fast or have big plans, but there's still some very basic principles that are pretty easy to pick out that are characteristics that can turn what might be a good opportunity into not so good, both that it might not be lasting, right? So it might take more efforts to research. You might see more quarter-to-quarter changes on it, and it might be more likely to be disappointing than performing better than you expect.
Yeah, it takes a lot of effort to stay involved with a company like that at times, but it can be very rewarding.
Yes, that's for me. That's Cedar Fair after the Great Financial Crisis was a profitable company, but in danger of being technically bankrupt because it was starting to violate the capital levels for its debt, and it was highly indebted. So it was either going to go to zero or it was going to quadruple. And that was interesting, and in the end rewarded, but it did not help me sleep easily at night.
Mm-hmm. All right. We did cover this one last week. I left it in here just as a reminder that he does make that distinction between core and non-core, and I think that investment versus speculation, the definitions cover it.
Mm-hmm.
Anything you wanted to add to this?
No, I think we covered this pretty well last week.
Okay. I still like the sex quote.
Yeah, I had to put it in there.
I'm allowed. All right. This kind of ties in with a nice discussion on being selective, but go ahead, Matt.
Yeah, I mean, for me, I've had very early in my investing career, I had the notion, and that's a whole other presentation of some type to put together, right? If you're going to jump into individual stock investing, you need at least three things. And the first thing is you need the interest in it, right? If it's a chore to you, if it's unpleasant, you will never put in the amount of effort. So you also need time, second thing, or have the discipline, the third thing, to stick to your guns when you're tested, right? When your stock drops 20% or 25% for no reason of its own, right? Because it's in the wrong industry or something like that. You need some basic things in order to gut it out over the long term when you're tested. And I think other than that, and I think our community would do well to acknowledge that indexing probably is the right thing, because people attempting this way without the right approach to it, any of those three ingredients missing, probably will do better over their lifetimes indexing, in essence, paying as little attention to it as they can, as trying to sort of dive in.
Yeah, and I agree completely, Matt. I think an 8 to 10% return over the long term, 20, 30 years, is fantastic. But as we have pointed out in a number of our sessions, if you can add a couple of percentage points here and there, the numbers just explode and get exponentially larger. And it's wild to watch that. And I agree completely with your point. You have to have the right, I'll say, psychology and the right behavior to really be an effective investor. And you covered that well.
And then maybe for the last 2 points too, right? The idea that investing in our way can be lonely, not lonely in the sense that we have our community, but it can be lonely in the sense of ignoring a lot of what talking heads or others are saying, right? Is literally saying, one, if we don't agree, we can still like each other, right? You can have a good, solid debate about things and then move on, not take things personally or color the current discussion from the last discussion. But also it's things people have missed, and it sometimes can be amazing what the market in the short term will focus on and will utterly ignore, to its collective detriment, right? That's the inefficiency at the boundaries of a mostly efficient market.
Yeah, and again, anytime I see a quote or think about that, not that I hold a grudge or anything, Ken, but I go back to my days in Chicago with Clayton Holmes, and I was attempting to persuade my investment club, and I'm generally pretty good at persuasion, but I could not get them to look beyond their biases about the product and trailer courts and all that kind of stuff. And they say, well, what happens in a recession? The next recession, don't these guys get killed? And anyhow, I cast the only affirmative vote for Clayton Holmes that night. And a few weeks later, we were on a discussion list, an email discussion list called the iClub list with Better Investing. And a guy by the name of Jim Clayton shows up, says, what would you like to know about my company? And first I accused him of being the Easter Bunny, which was bad form on my part. But it turned out it was the chairman and CEO of Clayton Holmes. And he went on to answer a lot of those questions. And one of the things he pointed out was, we do extremely well during a recession. Here, let me show you. And the other things that we can all miss are sometimes very tainted by our biases. And that was covered by Annie in her book. And sometimes you see things that aren't actually there, and you fail to see things that are right there in plain sight.
Yep. So Len,
I'm really relieved, Mark. I thought you were going to ask me to go find the photographer from the St. Louis paper that forgot to put your picture in the paper.
Oh, we'll cover that eventually.
I'm really relieved that we didn't go there tonight. Okay, or this afternoon.
We'll go there tonight, Ken.
We will.
Len has a good question. Is this? I sort of teed this up as an either or. Does it have to be either or, indexing or not? Of course not. And I'll say, so my chapter is putting together a beginning investing course, not beginning SSG, but as an outreach, right? To try and introduce not just better investing style, but but approach, let's say, college students at the beginning of investing at all. And one of the things we talked about was, do we say anything about portfolio management, right? What's portfolio management when you've bought your first stock? But very clearly, when you're thinking about that and about the benefits of diversification, and also while you're still learning, while you're more likely to make mistakes, which fortunately will be with less money probably, but as you're starting out, indexing is a perfect point there too. Now that isn't just a beginner's tool; it can go through there as well. But nothing wrong with letting some ride that you don't have to worry about, and particularly if that lets you focus on a certain amount of money or a certain number of stocks, a certain number of companies you want to follow.
Matt, I can't agree with you more, because I think there's a lot of places, lifetime places, where you have to remind yourself that there's a lot of choices to be made. My grandson is just beginning a 401k, and when he and I sat down to look at the more than 100 different options he had, and that's a change in and of itself. I can't remember that many options in the kind of companies that people were looking at 20 and 30 years ago in their 401ks, but he had over 100 choices, and placing some of those choices in good, solid fixed income was not a bad thing to convince him to do. I look at my sister, who I manage money for, and she was adamant that she was going to take a certain amount of her money and put it into, at the time she put it in, they were earning virtually nothing, but put it into a series of laddered CDs that she could count on if all of her stock market money went completely away. So, retirement, starting a new job, starting a job period, starting a new career, or going back to school, those are all times when there's a lot of room in your portfolio for things other than individual stocks. But the basis for growth, I think, is what you want to teach. That's where your portfolio begins to outperform what you might expect and get returns sometimes that are completely unexpected, and very rarely are they unexpected to the downside.
Well, what I've thrown up on the screen here for display is the bare naked million, which kind of answers the Len's either or question, in my opinion. I've used this a number of times with people just getting started. And again, this was from Christmas time, 2006. Somebody actually called us and said, what would you do with $1 million? So we were basically referred to this as the bare naked million. We put half of it into the Vanguard Growth ETF, which you see up here at the top. And so $1 million invested back then is now worth $6 million. I thought we would sell off the Vanguard Growth Fund over time, but it's kind of become the anchor to this portfolio, along with some playful stock selection of industry leaders. So I think Len is right on. It's not an either or. You can do a combination of these, and depending on who you are, I've seen family members do extremely well with very similar situations.
Absolutely. Absolutely.
Let me get back to where we're at here. Oh, wrong presentation. Sorry, everybody. Amateur at the controls.
As you can see in the next 40 slides, we'll begin to cover those in the next 5 minutes.
No, those were from tonight. One of the things that I did put in here is, why might you want to pursue that type of a bare naked combination? The type of thing that Len is talking about. Our community, these are not 5 companies chosen at random. These are the 5 most widely followed, probably most widely held companies. I know that Ken owns all 5 of them. I own 4 out of 5. The only one I'm missing is Cognizant. And just notice the return numbers. That's for me, it's the answer to why do this, because none of those are science fiction, and Ken has owned most of those for almost the time frame shown here.
Yeah, since at least the early 90s, late 80s, early 90s on all 5 of them. Yeah.
So, and again, we have the round table tonight. The round table, to me, and I don't think I'm hallucinating, is a demonstration that you can pick individual stocks. A group of people come together and generate this 15% return that you see in the middle of the page there, and it can be done. It's a fascinating demonstration of what is possible, from my perspective, anyhow.
Yeah,
Anything
Mark,
else?
these are five of my, these are in the top 8 performers in my overall portfolio. These 5, I only have 3 stocks that perform better than Visa does, that aren't Apple, Fastenal, Cognizant, or Microsoft. So you just, you don't need a lot of them. You just need, there we go, be picky.
All right. So getting back with Tillinghast, what are some of the general thoughts here that jump out, Matt?
Well, again, just starting from that mindset that you are looking for your investments to be perpetual, that kind of goes right along with Buffett's view of the 20 punches, right? If you had a punch card with 20 buys in your life, would this be one of them? I think this is the sort of the same thing. I do give point number 4 to Kim Butcher, right? Spin-offs are sort of counterintuitive to management. So if you're doing it, you must be doing that for some particular reason, because you have to. And she certainly has pointed out a number of good opportunities for those when they come up. The other, let me see, there's one other, I've lost it.
On that point, we'll probably, go ahead, Ken.
We can point directly to GE Healthcare, Matt, in the last 6 weeks.
Yep, that's what I was going to say. Probably take a much closer look at that one.
Oh, I remember what I was going to say. So we were doing more research on this same intro to investing, and trying to introduce better investing to a audience that doesn't know it at all. And so I have the handy dandy 1984 NAIC Investors Manual. Going and looking for George Nicholson's words on why are we looking to beat from 5%, and that's actually why I titled the slide that. It was literally so you would be picky. It's not that that's 3 sigma above standard or specific proof. It was a challenge to make sure it was something that was difficult to strive for and wouldn't necessarily be so easy to get.
Good point.
It was entirely qualitative, at least in that book.
All right. Just a few more thoughts as we wind down. This is certainly a famous, I think this is a Graham quote.
Yep.
Benjamin Graham, but the voting machine versus the weighing machine, and this points to the inefficiencies in the stock market. And the inefficiencies is a synonym for opportunity for investors.
Right. Graham said that in the short term, the market is a voting machine, but in the long term, it's a weighing machine. Meaning if you have fundamentals and they hold true, they will eventually come off, even if the market doesn't realize it in certain terms. So there's a lot of points to that, but I think that's very much in line with what we've talked about all this hour, on ignoring the noise, sifting out what may be true changes in the business, permanent changes in the business versus fluctuations of a sort. And particularly when it's just price-based.
I do like this one because it kind of dovetails with your comments on the reward aspect of this hobby that we love. You get paid for being a nerd and finding something like a Texas Pacific situation. And that's
I have to say, if you could stand another anecdote, my first investing love that I still hold one pristine share of is Pixar. They'll never get that certificate out of my hands. And I remember just before Disney bought them out, they were at a point where they were releasing one movie every 2 years and had been at that pace for a while. And all of the analysts were on the call saying, are you going to be able to do more? What would it take? And basically being skeptical about it in their notes. Meanwhile, there was actually, in order to expand to what's now their current headquarters, they actually had to take a local vote in Emeryville. So it was publicly available, the layout and plans for a headquarters that held twice as many people as what they had at the time. They had to vote to get a zoning variance to expand that much. and there were a few enthusiast blogs, namely Luxo, which doesn't exist anymore, but I'm grateful for them for pointing me to it. That it was publicly available, no matter how coy Steve Jobs was at the time, that they planned to double, and instead they were priced as if they would never grow again, and then they got bought out.
And probably rewarded you pretty substantially.
Yeah, pretty happy. I held that. That was in 2004, and I did sell my then Disney shares in 2021.
Mark, slide before last bullet, there's a typo, and it's not caught because it's a word. I think that should be fear.
Oh yes, yeah.
Okay.
There's a few. I've noticed a few. You're right.
The machine's not catching many of them, so it's you must have done pretty well. All right, this is an interesting topic, just because I think I have seen a number of investment clubs that actually scare themselves out of situations, and it's because of the fear of fraud. I mean, fraud's going to happen. Like I mentioned earlier, anytime you get into a bubble, look what just happened with FTX or FXT or whatever it is today. If you live in fear of that stuff, you're going to miss opportunities. So you just got to be a little bit careful about overthinking it. Obviously, you want to try to get some degree of comfort, but I've seen clubs spend weeks on this and then miss a genuine opportunity. And Ken is
That's
laughing because he's
interesting.
seen it too.
I actually interpreted the first point the other way, kind of going along in lines to Buffett's comments about there being no called strikes in investing. Right? He passes by plenty of things because he doesn't know them as they go together. But you're right. If you're stuck on it, if it's analysis paralysis, then it's a waste. But either you might take some of those spicier choices and know some of them will explode, will be spectacular failures, or just don't go there and know that that's not your style.
Some stocks will suddenly disassemble. Ken, did you have something else you wanted to add, or?
No, I just all five of these make sense to me, and especially the middle one, and that's unfortunately the one that I notice most in investment clubs. They find oodles and oodles of material, and they have absolutely no idea what the material says, and neither does anybody else that reads it, and yet it scares them half to death, and they move away from the opportunity.
I would say too, maybe as a corollary to that, if all of your information is coming from secondary sources, if it's all analyst notes and no 10K, maybe you haven't dug deep enough yet.
Really good point. Really good point.
All right, and I think this is our last Tillinghast slide, and it has to do with just some of the wraparound economics.
Yeah, obviously it's an important topic. Let's say that this year, right? The economics has affected the business world this year, maybe more than average. But there's a point that it works. But if we really have companies that are up straight and parallel, the whole point of those three words is they are not as economically sensitive. So that should allow you to, again, pull back from this flood of information more than most. But maybe my favorite point is the last one, right? It's a sold product, not a bought product. Economists forecast because they're asked for it, not because they want to, right? It comes on time. It doesn't necessarily mean it's as relevant when it comes out.
Well, as Ralph Acampora is famous for noting, anytime that he gave a prediction, it was either how much or when, but never at the same time. So never both conditions.
That's wise. That's a pretty standard engineering axiom too. You want it fast, you want it good, or you want it low cost. Pick two of the three.
All right. So Matt, I made a gentle modification to your slide, because I believe that with the power of community, we actually can figure out ways to handle the truth.
Right. This goes back to Annie's point, right? That speaking in absolutes invites conflict and doesn't invite discussion. So using language and with others and with yourself that really reflect exactly how certain you are of something, right? You want to bet, can open up your own eyes in terms of not just what you're seeing or what confirms your view, but if you see contradictory information, to be able to absorb that and take that in. If you think you're right and you've already bet your money and your fists are tightly clenched and your fingers are crossed, and there's some bad news that you could have avoided a bad situation, gotten out of it on time, then you might miss it. In fact, that's Annie's, is it her second book or the book she's got another one coming out, is on when to walk away. So
Yeah.
think about making the right decisions and everything on that. She's actually looks kind of at the opposite view. When is the right decision sort of to change your mind or walk away? Just if you think of how important that is to her to spend the time to write on it, think of that in terms of your investments.
I saw that she had done that, and I wonder if there might be some when to sell wisdom in there.
Yeah, yep. On the list. I have about a dozen on the list after this. That's fine.
All right. Anything else, Ken? Anything else grab you here?
No. Let's finish up. We have a really good program for folks this evening, and we promised them that we were going to cut this right to 3 o'clock if we could.
And we missed. Oh well.
We missed, right?
That is a picture of beautiful Busch Stadium, and Ken and I will be working with the St. Louis chapter tonight to deliver the program, our traditional monthly roundtable. But we're going to start at 7:30 with this session, Lessons from the Legends. It's going to focus on Stan Musial, Ted Williams, and Warren Buffett. And this is the set of pieces of wisdom that Warren Buffett mentioned in his 1977 letter to the shareholders of Berkshire Hathaway, and he's channeling Ted Williams's book on the science of hitting. And as you scan down that list, Ken and I were just marveling at, we could go in so many affirmative directions with these topics. We're going to start to tackle that tonight. We will not handle all 38 in the 45 minutes that we've been given, but we will pick a few and just have some fun. Try to learn a few things along the way. Okay. Again, just a reminder that we do archive these sessions on YouTube. We are above 1,000 subscribers, so thank you. If you haven't subscribed, please consider doing it, and we'll let you know anytime new content is added. And Ken, you're the one that mentioned David Carson from the St. Louis Post-Dispatch. Here's a little segue to tonight's session with St. Louis. David took that picture the day before yesterday, and it was published in the St. Louis Post-Dispatch. Pretty rare to see northern lights in St. Louis, and actually there were reports of seeing substantial northern lights as far south as New Mexico. So, and there will be more from David Carson tonight.
Conspiracy theorists will be out in force, Mark, okay?
You think? With that, I would like to just say thanks, Matt, for taking us on this 3-week tour through the works. The PDF of the session will include all the slides from the 3 weeks when I attach it today, so you can actually get all of them, including the slides that were hidden for today. And thank you so much, Matt, for driving this discussion and hitting some very key points to help people perhaps frame some of their investment decision making, especially in group style, in a strengthened way. Thank you.
Yeah, thank you, Mark. Thanks for indulging me. It's been great to kind of get it out there and talk about it, and I have a lot to think about as I try and keep hammering it, get it to be tighter and more impactful, more easily impactful.
Good job. And Ken, I will try to make a T-shirt up with the turkey and the helicopter for
Right.
the weekend in Cincinnati.
Mark, before we leave, Phyllis, I'd be glad to get you a link to this afternoon's or tonight's session. If you could just type your email address in as a question I'll be able to see it, copy it down, and I'll send you something right after we sign off here then.
Okay,
That
anything
was
else?
for Phyllis.
Tonight's tonight's session is available under upcoming events at Manifest, and you can go ahead and register there.
Okay.
All right.
Don't sign off, Mark, until I copy this. Okay.
Okay, I won't. Any other comments or questions?
No, we're pretty well caught up, except for this guy from Maryland keeps trying to be funny. I don't know if what's going on here, but he sent me his email address as well. So he says he is funny. He's not trying.
Well, he is in a funny sort of way.
All right.
And there are the details on the sessions that are going on in Cincinnati, and then Cy's actually working with the Indianapolis chapter. We're up head to head, so you have to pick one. But Cy will be giving a presentation on portfolio-centered decision making and his growth stock portfolio that's in Better Investing Magazine. And Ken and I have been on this program before with Dr. Matt Will, and it would be kind of interesting to hear his outlook on the banking crisis.
Right.
Those two programs are out there.
Phyllis, I have your email, and as soon as we sign off here, I'll send you a link to tonight's program.
All right, so with that, we'll go ahead and get ready for tonight. Thanks, Ken.
Thanks, Mark. Thanks, Matt. Really, thank you a lot.
Yep. Thanks, guys. Always fun.